This is the end, beautiful friend.
TickerTank.com. Visit, enjoy. Nick Fenton, founder, TickerTank.com. Coming at you part 7. This is the final video of our short strangle strategy series. So I just want to have a brief conversation on adjustments. I want to start by saying this is the way I approach short strangles is in a manner that positions me in a very high theoretical probability of success. In this case of the UNG example we've been utilizing throughout this video series, right now it's showing 79%, over 79%. So very high theoretical probability of success. Generally, with my minimum acceptable probability of success being 70%, that puts me in a scenario where, to be completely honest with you, I don't get tested that often, but I would be a liar if I told you I never got tested. And that's one thing I hate is liars, so I'm not going to sit here and lie to you and tell you that you don't get gut checked with these types of strategies ever. The first thing to keep in mind is this is a high theoretical probability of success strategy. In the event you do get gut checked, when I say gut checked, I mean tested on the upside or tested on the downside. So say UNG is currently almost 22. Say we have a significant drop and it's drops down to like 17. Then you're getting tested on the downside in that case. Or say there's a significant pop and it pushes up to 27. Then you're getting tested on the upside. That's all I mean by that particular phrase. So let's just say that in the next few days, UNG has a significant drop. Because at this point, I think there's more potential for downside in UNG. So I think a drop would be a more probable scenario. And so let's say it drops to 17. And let's say it happens in the next few days. So currently, if you go to our trade tab, UNG, we did the February, there's 57 days left. And let's say it happens when there's 52 days left. You have to remember that duration is your friend. You can't make a brash decision right away if you get tested and gut checked. You just have to let duration do its thing. Duration is your friend, so let duration be your friend. That's one thing that was kind of difficult for me to grasp several years ago, but I've definitely grasped and realized and completely understand now. There's been so many occasions where I've made quick decisions that ended up being very bad decisions. When I still had so much duration left in the trade that if I just would have sat back and not worried about it, I would have, it would have come back into the range and I would have been fine. But we're all human, and humans do make brash decisions, especially when we're getting tested with financially. When you see your P&L, when you're starting to lose some significant amount of money, a few $1,000s, then your brain's going to kick into, oh man, I have to do survival mode from a financial perspective, and there's a very strong tendency for the human psychology to react to that. And you just have to push that to the side, and it's not going to be easy to do, but let duration do its thing. So let's say there is a scenario where we've been in a position kind of like this one. Say we entered with 57 days left, 57 days of duration on entry, and we're all the way down to about 25 days of duration. So we've seen a pretty significant duration decay, if you will. 50% of the theta decay potential has taken place. So we've gone from about 58 days to 25 days. There's only 25 days left in that trade. That's not an awful amount of duration, but it's also not a whole lot of duration. And let's say with that 25 days left, we're still getting tested to the downside. And we'll say it's trading around 16 bucks right now. You're down a few $1,000s. Well, in this case, when I start getting down to those levels of duration, I generally will I won't do anything with the tested side, which in this case would be the 18 puts. But what I would do is I would move the untested side closer to the money. So I may move these 26 puts down to maybe 20. And the way I choose what strike I'm going to move those 26 puts down to is the same way I chose them from the jump. I would go to the trade tab, and I would go to the calls, and I would go down this probability in the money column, and I would find the call strike that was closest to 16%. And if there was 25 days left instead of 57, like there is right now, say this 57 was 25, and say that this last price instead of 21 was 16, like we were just saying. So the 18 puts are being tested. You would probably be looking at around the 20 strike for a 16%. That's a complete guess, but it's going to be somewhere right around that level. 25 days left and 4 points out of the money. So just, I can't give you a real example here, but that's what I do. So I roll the tested side down. I stay in the same month in that scenario, but I roll the untested side closer so that I can basically realize profits. When I say roll, essentially all I'm doing is I'm covering this 26 February put. I'm realizing the profit on that one. So I'd probably at that point be able to cover that for about a nickel and realize the profit, whatever I sold it for versus whatever I covered it for is my profit. And then reopening that call in the same February option month at a closer to the money strike, so that maybe that call is worth say 40 cents. So instead of just sitting on one that's sitting, trading for a nickel and is just going to basically do nothing for the next 25 days except maybe gain another 5 cents, I'm moving it to one that has a lot more premium decay potential. Now, granted, that does reduce my range significantly, so you have to keep that in mind, but it's just kind of the mechanical thing to do. And in the cases where I have had a tested side with a minimal amount of duration left in the trade, and I've done this roll down, it has worked out more often than not. Kind of a last-ditch effort. If it's 7 to 10 days left until expiration, I really don't like holding until expiration. Actually, 7 to 15 days left until expiration, sorry. I don't like holding into expiration week. I really don't even like holding into late in the week prior to expiration week, so Thursday, Friday prior. So usually like 7 to 10 days left until expiration, not trading days, just business days. 7 to 15 days left. I'll consider rolling the entire spread to the next month. So essentially all that means is you're covering the entire strangle, and that may be this 1826 strangle, or it may be the 1820 if you've rolled down the untested side into the same February month. So say you're holding the 1820, you've done the untested side roll down, haven't touched the tested side. You may roll that 1820 to March as an entire spread. So essentially you're just closing out the February, realizing a loss, and moving it to March, trying to basically get enough premium from moving to March to where you're getting back to break even and potentially making some profits. So you're not going to have to, in closing on this adjustments, it's really not something you're going to find yourself doing a lot, believe it or not, because you're getting a significant range here. I mean, let's get a visual of this one more time. 1745, 2655. Go over here to charts, and let's go to style, settings. We're going to need to move our price axis up a little bit to be able to view the 2660. Nope, that's not going to cut it. So we'll do 20. Let's just do 30 to make sure we get it. That's a little too much. 20. Okay, so there's going to be 2660 there. Let's move our time axis so that we're able to see 50 bars to the right so we can see the Feb expiration. Alright, so 1740. I'm going to pull the channel tool up. 1740, right about there. And 2660. Or 2655. So we'll just call it, that's close enough. That's fine. And so there's our range. And let's just make an oval on February expiration. So you can see down here, we've got the dates. And we're going to be on 2/21 as Feb expiration. So right around here. So this is kind of our range. it looks pretty darn good if you ask me. I mean, we've got support down here. We're well above 52-week highs in UNG. But at the end of the day, anything can happen. You can get tested. Just because we have a really wide range and a high theoretical probability of success doesn't mean that there's 0% chance of us getting tested on this trade. UNG could tank and go below 17 support, or 1740, whatever. UNG could continue to rally like crazy and push above this 26 level. Granted, both of those scenarios are quite improbable, but they can happen. So knowing what to do when they happen is important, but the most important takeaway from this brief conversation on adjustments is duration is your friend. Do not, try not to. Again, I'm not an advisor, so I'm just sharing with you the way I approach things. I don't want to get any legal trouble here, but duration is your friend. Let it be your friend. In the event you get tested early on in the trade and you have 50 days of duration left, take a deep breath, man. Just sit back, chill, let duration do what it does. Let keep an eye on the price action of the stock, but don't watch it tick for tick. Just try to kind of push it away and realize that you have a ton of time left in the trade, and that you're in a theoretically high probability of success. You got a nice range-based situation here. Most of the time, you're going to win. And I'm very successful with my short strangles, which is why I allocate the majority of my capital deployed to this particular strategy. Now, I do practice strategic diversification. This isn't the only strategy I do. I have tried 100% strangle portfolio before, and like I said, I got crushed, so I'll never do that again. The importance of strategic diversity I can't stress enough, but I also can't stress enough the importance of letting duration do what it does best, and that is get you out of trouble after you're in trouble. So let duration be your friend. In the event you're short on duration, consider rolling one of the untested sides down so that you can get a little bit more juice out of it. In the event you've already made an adjustment, or you still like the strangle, you haven't made any adjustments, you're starting to get into a situation where you may get tested, you just want to extend the duration a little bit, roll the entire spread to the next month or 2 months away. So in this case, move the February to March or April based on the time criteria. So if March isn't between 40 and 70 days time criteria, and April is, then you'd want to roll to April. Hopefully that helps. Hopefully this series was as great as I want it to be, and as valuable and eye-opening to you as I hope it is. And at the end of the day, I just really enjoy clarifying these types of things, being very in-depth. I don't see a whole lot of really detailed stuff like this on YouTube. Everything's really brief. And it reminds me of the early days of my options trading when I was reading all these books. And the books gave you an idea of what the strategy was and what it looks like on a graph. And I could conceptualize the idea pretty well, but actually going in and applying there were so many questions that popped up when I got to that stage of the game. And I've answered those questions via trial and error and via talking to some seasoned veterans throughout the years. So since I've been able to answer those questions and apply those answers effectively and consistently make profits with these types of strategies, I just think it's really fun to share this information with people that are interested, since it's such a small niche of individuals that are interested in this style of trading and understand the power of risking way more to make less. Risking 9 or 10 to make 1. Sounds completely counterintuitive, but it's the way that you consistently win in trading. And the beauty of options, if you're focusing on liquid options and not screwing around with those illiquid pieces of crap out there, the beauty is it's the only financial vehicle that you can, or financial instrument that you can utilize to modify your probability of success. So you can do futures pair trading and stuff like that to kind of give yourself a little bit better than 50%. But options you can modify significantly depending on your strategy. And it's just a really powerful tool. And when you really understand the in-depth characteristics of each of these strategies, you can start really making a pretty damn good living off of this stuff. So, like I said, I'm here to provide some stuff that I don't really see other people providing on YouTube. I hope you enjoy it. Nick Fenton with TickerTank.com. Check out my website if you enjoyed the series. Feel free to leave some comments, and I'll do my best to answer them as quickly as possible. Take care, and best of luck in your trading future.